Global stocks are mostly flat, reflecting anxiety over a fresh outbreak of COVID-19 in China. The financial hub Shanghai reported around 21,000 new coronavirus cases on Thursday. Investors worry that will force the government to extend an ongoing lockdown in the city of more than 25 million people. Stocks in Hong Kong are down, led by tech shares like Alibaba and JD.com. Meanwhile, oil prices have declined, with the benchmark Brent falling to around $100 a barrel. The Chinese economy is already on track to grow at its slowest pace in decades this year. That's partly because Beijing has refused to stray from its zero-COVID strategy. It involves mass testing and strict movement restrictions, even as other major economies learn to live with the virus.
This round of epidemic could affect high-risk populations, including the elderly and children, because if they get infected, they will be seriously affected by the virus, especially the unvaccinated.
Now, for more on the story, let's go to Naeem Aslam. He's the chief market analyst at AvaTrade in London. Welcome back to the program, Naeem. Now, pretty much everywhere we're seeing governments start to learn to live with COVID-19, the main exception being China. What kind of effect will this have on the world's second largest economy?
Thanks for having me. I think in terms of investor sentiment, we are already seeing the reflection of that in the stock market. I mean, look at the Asian stock market's performance this week. What's been the concern? Two major concerns. A is, of course, the Federal Reserve's hawkish monetary policy, and then B is that extensive non-tolerance COVID-related policies by China. Now, of course, if China continues in this way, it's not only going to have an influence on its GDP growth, on its economic growth, manufacturing data, consumption, but we are also going to see the spillover influence of that. Because if we see even still some of the companies, like for instance Ford in the United States, they came up with their quarterly earnings, and the numbers were a lot more less than what the market was expecting. And everyone was blaming on one thing and one thing alone, and that is the chip shortage. And guess who produces the largest number of chips in the world? Of course, it is China. And if these non-tolerance policies will continue, that means more issues with the supply and more slower economic growth in China.
Right. Can we explore that point a little more? Because this is also having an effect on commodity prices, isn't it? Just how important is China in terms of demand for oil, metals, and other key commodities?
Certainly. You see, when it comes to oil and soft commodities, it's a two different stories altogether, because China has a history of buying oil from the sanctions countries. Like we've seen that China buying oil from Iran. We are still seeing China, buying oil from Russia because it's just cheap. Now, in terms of the soft commodities, that's a very different story altogether, and that will have a greater influence.
All right, Naeem Aslam from AvaTrade in London. Thank you for joining us.